In the vast world of finance, the foreign exchange market, or Forex, stands out as the largest and most liquid marketplace. It's a whirlwind of activity where currencies are bought and sold round the clock. But for most individual traders, navigating this complex landscape requires a guide, a Forex broker. Forex brokers act as intermediaries, connecting individual traders to the broader market. Think of them as bridges between your trading platform and the vast network of banks and financial institutions where currencies are exchanged. When you click buy or sell on your trading app, your broker executes that order for you, taking a small fee for their service, typically in the form of a spread or commission. However, the way brokers connect you to the market can vary significantly, and this is where the concept of market making comes into play. Understanding market makers is crucial to understanding how Forex trading works and the potential conflicts of interest that can arise. In essence, a market maker is a firm or institution that provides liquidity and facilitates trading by continuously quoting buy and sell prices for a given currency pair. They essentially make the market by ensuring there's always a buyer or seller available, even for less commonly traded currencies. Imagine a bustling marketplace. Market makers are like the merchants with stalls always stocked with goods, ready to buy or sell at any time. This constant availability of buyers and sellers is what makes the Forex market so liquid and efficient. However, the role of market makers isn't purely altruistic. They profit from the difference between the bid, the price they're willing to buy at, and the ask, the price they're willing to sell at, known as the spread. While this spread is generally small, it constitutes the market maker's compensation for providing liquidity and taking on the risk of holding positions. Now here's where things get interesting. Some Forex brokers also act as market makers. This means they're not just facilitating your trades, they're actively participating in the market, potentially taking the opposite side of your trades. For example, if you place a buy order for EUR/USD, a broker acting as a market maker could fulfill that order from their own inventory of currencies. In essence, they're selling to you directly, profiting if the price of EUR/USD falls. This dual role, broker and market maker, creates a potential conflict of interest. While not all brokers engage in this practice, it's a prevalent model in the Forex industry. This isn't to say that all market-making brokers are working against their clients. Reputable brokers understand that their long-term success relies on providing transparent and fair trading conditions. To ensure a level playing field, regulatory bodies around the world have implemented rules and guidelines for Forex brokers. These regulations often include requirements for segregating client funds, providing transparent pricing, and disclosing any potential conflicts of interest. When choosing a Forex broker, it's crucial to prioritize transparency and regulatory compliance. Opt for brokers licensed and regulated by reputable authorities, such as the Financial Conduct Authority, FCA, in the UK, or the Australian Securities and Investments Commission, ASIC. Additionally, carefully read the broker's terms and conditions, paying attention to their order execution policies and any disclosures about potential conflicts of interest. A reputable broker will be upfront about their business model and how they manage potential conflicts.